Welcome. Let's take a look now at Friday's US jobs report. It's the last one for 2017 because it's a December number. The effects of the hurricanes in September now wearing off. This is expected to be more representative of what's happening in the US economy. Economists are saying this is a return to the underlying trend. We're looking for a number of around about 188,000 jobs having been created in the US economy in December. The unemployment rate remaining at 4.1%. An average earnings month on month readings expected there of 0.3%. Now, December's release is a month which is dominated by the weather. And December was a fairly benign month, although the snow did begin in earnest in many areas towards Christmas. So let's take a look into more detail about this number. Josh is with us with some more analysis. Before we get on to a trade idea around this, as I was talking about the December number, it does have some potential for some outlying numbers to come through. How important in your mind is this figure?
I think as time goes on, we're actually going to see less of a reliance on the unemployment figures. I think we're going to see more of a focus on what's happening in terms of inflation. As we get closer towards what you would consider to be the sort of natural bottom for unemployment rates, there's only so much we can actually see continued job creation, and certainly it has been at a pretty steady pace. And of course, you see these different impacts in terms of weather effects. But I think going forward in terms of Fed thinking, people are going to be thinking about what's happening in terms of inflation. We're seeing the devaluation of the dollar, we're seeing the rise in terms of commodity prices, and we're seeing the implications of these tax reforms. All of those should push up inflation, and that's the kind of thing that I think is going to be really heavily hitting the Fed decisions going forward. Certainly, whenever we're looking for the payrolls and these jobs reports, we pretty much always see big volatility around it. I just don't think there's necessarily going to be the same kind of reliance when we're talking about data dependency on Fed thinking on the jobs numbers as they have been under the Yellen sort of governorship. So what we're seeing in terms of the markets is, for me, the possibility of some sort of bounce back. Now, certainly we have been seeing 2 weeks of very heavy selling. This is the dollar index on the weekly time frame. What we can see here is back in the last year, very strong selling, and we can see that essentially, despite the fact that we saw a rebound from around about this trendline support and we started to look like we're going to be in a more bullish phase, the inability to break the 94.93 and the break below 92.20 looks like it's paving the way for the potential for further downside. But the thing is, of course, we've seen such a strong move towards the downside recently, and with these jobs numbers coming out, you know, the expectation of around about your 180s on the payrolls numbers, that's the kind of number that we could get a beat on. So if we were to get a decent set of figures, we could see, at least in the short term, some sort of relief rally and some sort of bounce. Like I said, because of these number of different factors pointing towards a potential resurgence of inflation in the US, that could pave the way for the Fed actually doing more in 2018 than markets would expect. That should be bullish for the Fed. Of course, that hasn't necessarily come to fruition yet, but it's certainly something that could gradually play into investor mindset. And if we were to see some strong numbers come out, then this could pave the way for some sort of relief rally, some sort of bounce in the US dollar, if only to give us a retracement of this rally, this sell-off that we have been seeing over recent weeks. Take it back to the daily time frame and see this market is relatively clearly defined on a bearish pathway with a break below this neckline on the head and shoulders formation. But given the fact that we're now oversold, we're starting to turn higher around about the area where previously we have seen significant support on a stochastic area, and we're coming into this payrolls release. I think possibly the risk is that we're going to see some sort of rebound for the short term, but that should play into the possibility of us being able to get short if we were to rally into, say, a 92.22, which is your previous low, and 92.50s, which is around about your neckline of this head and shoulders formation.
Okay, all right, Josh, thanks so much indeed there for that. That's taking a look at a trade to watch out for around the release of those numbers. And here we are 2 days away from that. Clearly, there could potentially be a lot of foreign exchange water to pass under the bridge of the dollar index before then. So we may see different quotes around about that sort of figure as we approach the numbers on Friday. Chris Beecham and I will be live at 1:25 on Friday on the IG platform with a look at these numbers and how to trade them around the release. We'll also be going to the trading floor here at IG as well with some analysis on what the clients are doing in terms of client flows around the release of the figures at 1:30 on Friday. Hope you can join us for that. Subscribe to IG for educational content, company insight, financial analysis and expert commentary. Or visit our website for daily market updates, trading ideas and strategies.